And welcome back to School for Startups Radio. We are so very excited for our weekly Wealth Within update with Dale Gillum. He is author of the book, Accelerate Your Wealth. It's your money, your choice. Every week now we are doing a feature on the macroeconomic situation, the stock market, the GDP, all of the things that us entrepreneurs need to stay aware of. Dale, welcome to the weekly update. How are you doing this week? Are you feeling better?
I'm feeling a lot better, and as you can tell from my voice, I can talk better, but my wife liked it when I was quiet. I'm not sure why.
Well, I'm not going to go there, Dale. I want to stay on your good graces. We had yet another bad week on the stock market. What is this, week number 6 in a row down market? And it was down pretty big this week, right?
Yeah, I mean, the Dow Jones was down around about 6.6% in May. So whilst we were down last week, down 1 or 2%, overall, like I was saying last week, anything up to about 12% really doesn't worry me too much. Now, I did think the market was going to hold up last week and trade up, but then, a bit more talk about with Trump coming out with his possible 5% tariff on Mexico. That's possibly pushed the market down again. But both the S&P and the Dow down around 6.5% roughly, but they've both got strong support. I know the S&P's got strong support at 2,700 or 2,722, and between that and 2,650 or 2,650 points with the Dow. A lot better levels on the Dow. That's between 24,792 and 24,204, and I think the Dow's got a lot more support there. So I think those stocks, and you've got to look at the Dow stocks because they're obviously some of the biggest stocks in the US, and I think that's not wanting to go down, which says to me sentiment's not that bad, even though the Dow fell 3% last week on news of that 5% tariff. But it is, I think we need to be prepared for maybe another one more week down possibly, but I don't think it's going to be too much.
We're still up for the year though, right?
Yeah, absolutely. Both markets, all the markets across the US are up for the year, and so it's still looking good in terms of overall. And this is why I say to your listeners is don't ever look at the market on a daily basis or even a weekly basis. You've got to look at the big picture. And I always say to people, you can't tell where you are in a stairwell while you've got your face pressed up against the step. If you pull back to look at the bigger picture, you can determine whether you're at the top of the stairs or the bottom of the stairs. And then what you got to do, whether you got to go up or down. And as we know, markets go up in stairs, they come down in elevators. And right now, I don't think we're at the top of the stairs with the Dow and the S&P. I still think they've got further to go. It's normal to have a pullback on the marketplace. Markets rise for 4, 5, 6 weeks, fall for 1, 2, 3 weeks. Then they rise again for 5, 6 weeks again. But then every couple of times here, as I mentioned last week, they'll fall 4, 5, 6 weeks. To readjust a little bit the momentum, and I think that's really all what's happening now is momentum is adjusting on the Dow and the S&P after having quite good runs over the last 6 months. So it's looking quite good.
What sectors are we particularly interested in from last week? Who were the big movers last week, both up and down?
Yeah, real estate was up around 1.7%. Again, that was up the week before the best sector, and utilities was up by 1.39%. Generally, utilities can be a defensive area. A lot of people like to go to utilities because of the consistent cash flows from those. So therefore, companies or utility companies tend to have consistent profits coming through. So they tend to be a little bit more defensive. So that doesn't surprise me. But you can see the worst sectors for May. Energy was down around 7%. Technology, which was surprising, down about 7.12%. Technology was down, but and technology is about, if you're looking at the FANG stocks, they're 20+% of the S&P 500, and we're seeing a lot more technology in the S&P 500, not so much in the Dow, and I think that's probably why the S&P is probably fallen a little bit more than the Dow.
And any particular big movers, any individual stocks? I think NVIDIA, the video card company, fell something like 25%, didn't it? What's up with that?
Yeah, a lot of those stocks were down. Yeah, those stocks, we're talking about, the worst performance, NVIDIA, that was down 25%. Qualcomm, that was second worst stock at 22.42%. Now, quite interesting in NVIDIA, they're all three. Actually, all three of the worst stocks were in chip manufacturers. Now, whilst Qualcomm is more in mobile phones and Nvidia is more gaming chips, but Nvidia last month reported had better than expected quarterly profits, and revenues were above analyst estimates. Sorry if I can say that. But it's around about $135 now, and it's got really, really strong support around 112. So I think this sort of sector, or those three stocks, they do look all right to stick on your watch list. I wouldn't buy them right now. The other one was called Broadcom, and it was down about just under 21% for May. So currently, it's got supported at it's currently at $251 with good support just below that at 238. But I think these could be some opportunities. But it seems to sort of defy a little bit of logic. We're having more mobile phones now, more people are gaming, more people are buying computers. So how are they getting hit like this? And to me, that can spell some opportunity on those stocks. I know they're competitors with each other, but it is looking quite good.
So, Dale, let's talk specifically about the Mexico situation. Now, I want to start off with a sort of political question. Is the stock market always this tied to what's going on politically and the last tweet of a president? I don't remember the stock market being almost in parallel with how bad or good the news is about the president. What are your thoughts on this?
Yeah, look, to me, there's probably a couple of answers I can give you there. One of them is that generally the government of the day, they're sort of like the captain of the Titanic. You know, the captain of the Titanic knew the direction. He was just got the band to play and made everybody feel a bit more comfortable as it went down. So he couldn't change what was going to happen. Now, governments, they've got fiscal and monetary policy that they can tweak and do all sorts of things. But that's like trying to turn the Queen Mary. If it's real slow, what happens in terms of that. So having a quick effect on the stock market's not possible. But what's going on now, and what probably more the last 10 years, is we're much more of a victim of being technology driven nowadays. You know, iPhones are just over 10 years old. We've got these smartphones all over the place where we get information at the speed of light. And the big end of town uses that on us by pushing out tweets. They push out news to get us, or the average American, to make decisions about their stocks and create this volatility so that they can make more money. And that's really what I see happening. Is the tariff on Mexico's, whether it comes in or not, it might have a bit of an effect on the stock market, simply because, yes, US companies will be affected of it, and probably one of the major ones is the motor vehicle industry, because there's a lot of motor vehicle parts coming from Mexico. But that's just going to increase the costs of those companies, and they're just going to pass it on to consumers anyway. So it might see it slowing down a little bit, but it doesn't really, to me, augur for a big pullback, if that makes sense. And right now, America, Trump's got that catch, right? Make America great again. So to some degree, there's no pain, no gain without pain. And unemployment in the US is low. Consumer confidence is up. The economy is growing. So that's why I'm thinking that the US markets will just go back to being bullish again.
Do you think it takes anything out of the GDP growth for the quarter or the year?
Oh, it probably will. It will slow down that a little bit. But again, it's just proposed. It hasn't come in yet. So when it comes in, it might do that. But then it might be a lag of 3 months, 6 months, even 12 months. So right now, not a major thing to be worried about from a portfolio. I always say to people, focus on your portfolio and your stock. Don't focus on what the broader market's actually doing. Because when you look at the market in terms of looking at what your individual stocks are, you can make a decision. Because as an investor or trader, all I can do is decide when I buy and decide when I sell. That's all I can do. So all these drivers are going to be around about in the market, pushing prices around of the market and individual stocks. But I just need to narrow my focus down to what am I actually doing and what's my goal and what am I trying to achieve. And so you don't need to make immediate decisions on that, and stick to your portfolio management that I teach in my book, Accelerate Your Wealth. I teach people how to set up a portfolio, how to manage it, and how not to get too caught up in this sort of economic factors.
Dale, one of the things that we've been doing over the last couple of weeks is looking at some of the indicators, in particular margin debt, and how it's tracking toward overall market growth, and how this is an indicator that's really important for us. Explain all of this, please, and what it's telling us.
Yeah, crashes in markets are really driven by debt. And what I mean by debt is overuse of debt or euphoric borrowing of funds. And we saw that with the 29 crash. That was all debt. All major crashes are caused by debt. So studying debt levels helps you understand how bullish or bearish the market may be and how fast it may be moving in those areas. So prior to the GFC, we saw absolutely major borrowing money to get into investments. I'm not talking about just borrowing to buy a house. I'm talking about using your borrowings to invest in things. And we see a lot of margin lending go through the roof. We see major records, all-time record, people moving into mutual funds. We see all-time record borrowing to get into funds and other types of investments. Once a crash is over, we see the opposite. We see the biggest amount of people exiting mutual funds and exiting their borrowing. So that's what I would say to people is right now we're not seeing speculation or rampant speculation in borrowing and everybody around you borrowing to get into the marketplace. I know we did see that with a little bit about people borrowing to get into Bitcoin market. So that's sort of probably a more recent one that I can suggest that people look at, and people are using all sorts of things to get all their money into Bitcoin and speculation. We're not seeing that on the actual stock market itself. And that's why I'm saying our market can't crash, because we're not over pushing that debt.
Dale, we only have a minute or so left. Give us your prediction for the week. Surely we get an up week now. Surely we deserve it at this point.
Well, we do, and as I said a little bit earlier, markets move up for 4 or 5 weeks, come down to 1 or 2 weeks, and we're down for 4 or 5 weeks at this point in time. So logic or history says we should be going up for 1 to 4 weeks right now. But just sit back, relax. As I said, I don't think it's going to fall too much at this point in time if it does.
Fantastic. Dale, enjoy. Is it the beginning of winter there for you? It's our first week of summer.
Yeah, we're 3 days into winter right now, and Melbourne, where I'm currently sitting, is about mid-50s. So that gives you a bit of an idea.
Okay. Dale, we'll talk to you next week after we have a good up week, all right?
My pleasure. You take care.